Hi, and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I'm going to talk about valuation and why valuation of a company matters so much. And afterwards, I will give an update to my portfolio as well. So let's start the talk on valuations with a most recent example, namely Netflix. So what you're seeing here is the price development for Netflix over the last week. And as you can see, the stock is down more than 36%. If you go to the year-to-date graph, you can see it's down close to 64%. But if you go to the 1-year graph, you can see that Netflix topped out at close to $700. But if you go to the full history of Netflix, you can see that the stock is actually still up more than 19,000%. So when you're looking at a graph like this, then you don't really have to be a brain surgeon when you look to this number, 19,000%, that this would have been a tremendous investment if you have invested in it back in the days. But at the other hand, if you have just been investing in it within this year, well, then you are down more than 60%. So what is going on here? What is happening? Well, all of a sudden, when you look to the long history here, you had an extremely successful business that just kept on growing and growing and growing with around 20 to 30% every single year. But now all of a sudden in this streaming service business, they are facing much fierce competition compared to what they used to. Now you have Disney Plus, you have HBO, you have Amazon Prime, and so on. So all of a sudden, Netflix are now starting to share the market with a lot of competitors. And when Netflix came out with their quarterly result, they were for one of the first times reporting a significant decrease in the amount of new subscribers, meaning now the business model on Netflix no longer hold truth compared to what you have been invested in if you were investing in this business a year ago. And if you have been following any of the financial news within this week, then you will know that Bill Ackman, who is the CEO of Pershing Square Capital Management, has taken a loss of more than $430 million since he originally invested in Netflix back in January this year, meaning he have only been holding this stock for a little more than 3 months, and now he is taking this massive loss. But if you listen to his words, then it actually makes a lot of sense, since he have completely lost faith in the company when he was seeing these new quarterly results. And I mean, when you are looking to the history of Netflix, of course it is quite easy today to sit and judge and say, shouldn't he have known better? But I mean, if you are looking to all the history of Netflix and are seeing how much they have been growing, well, it is quite tempting when you look to a 1-year graph and you see the drop from 700 and all the way down to 360, that perhaps this would be a good time to invest, since you could buy with a large discount, especially if you are expecting the company to continue to grow with this 20 to 30% every year. But now when you're seeing that Netflix can no longer hold up to these numbers and that they were actually starting to lose a lot of subscribers, well, all of a sudden the valuation of the business no longer hold truth. And then as a true value investor, that is actually a really good reason to sell a stock. And just to add a little more insight here, when you're trying to judge whether or not Bill Ackman was doing a good thing back in January, if you're looking at the insiders, then you could see that the co-founder and CEO of Netflix was buying a little more than 51,000 shares back in January as well. So I mean, viewing it in this light, perhaps it was really not clear what was going to happen with this company. Another good example would be to look at Disney. And of course, I can much better relate to Disney since this is a stock which I have previously had in my portfolio. I initially bought it back in the beginning of 2020, and then I already sold it in the middle of December in 2020 as well. I sold it due to the fact that I believed that the company was significantly overvalued when it was trading at a PE ratio of around 90. But as you can see from this graph, it is pretty clear that I didn't sell it at the complete top. Of course, this is extremely rare that you will ever sell anything at the complete top. And I would of course have no way of knowing that Netflix now here in 2022 would come out with such a bad quarterly result, which are heavily affecting all the streaming services, because now it is more clear to everyone that there is a really fierce competition and you cannot expect to see the same growth rates as you have previously seen for these companies. Hence the valuation has to come down. So this is a classical example of Benjamin Graham, where stocks become more risky, not less, when they are increasing in value. And when you are seeing companies trading at really high valuations, then you know that a lot has already been built into the expectations of the companies. So if just small things go a little wrong, then it can have a huge impact on the price. Since if you had a premium valuation, then you are really expecting a lot. Another way of phrasing it is, of course, if you are expecting a lot, it is much easier to get disappointed. So this is another way of formulating that a stock becomes more risky, not less, as it increases in value. If we then continue to my portfolio, well, the first thing we immediately notice is that there was a red circle for this week's episode. If we then go to the portfolio values tab, then you can see that my portfolio is down exactly $3,000. And if we continue to my favorite tab, namely the dividends tab, then you can see that this has been quite an astonishing week for me, since I have received dividends from Store Capital and ADC. So in total, a little more than $200, bringing me to a total of $469. And I don't expect to receive any more dividends in April. And if we then go to my forecast sheet, then I have updated my formula since I have now finalized April. And you notice here that this number is lower than what I had forecasted. So of course this influences my forecasted retirement. So if we scroll all the way down here, in last week's episode, I would be able to retire in exactly 20 years in April 2042. But since my realized dividends in April were lower than the forecasted, now it has added an additional 5 months, meaning that I wouldn't be able to retire until September 2042. But if we then go back to the dividends tab here, you can see that I have 1 month every quarter where I'm receiving a significant higher amount of dividends. So naturally, my forecasted retirement age will move back and forth. And that was what I tried to explain last week, that it don't matter too much whether it is in 19 years or in 21 years. I know that this forecasted value will move back and forth from time to time. And if we then go back to the overview arc and scroll all the way to the top, just so you can see how each individual stock has been performing within this week, now is your chance. So that actually sums it up for yet another exciting week of the Lazy Money Game. So if you have enjoyed the content, then please consider leaving a like. It really helps out the channel a lot. And until I see you next Sunday, bye!